Every major bull market begins the same way, quietly. While most people chase headlines, AI stocks, crypto narratives, political drama, the real move often starts elsewhere. In something physical, something essential. Something the modern world relies on but rarely pays attention to. That's exactly where silver has been. And now it's no longer hiding. Silver just crossed $58 per ounce. A historic high. In less than a year, the price doubled, from roughly $29 in January to nearly $58 today. That's not hype. That's not speculation. That's reality. And the most important part of this story isn't what already happened. It's why the next move toward $100 isn't extreme at all. It's overdue. Because this rally isn't about silver suddenly becoming expensive. It's about silver finally catching up to where it should have been all along. Let's start with the foundation most investors never hear about. The structural deficit no one talks about. Silver has been running a supply deficit for 6 straight years. Since 2019, the world has consumed more silver than it produces every single year. In 2025 alone, the projected shortfall is around 117.6 million ounces. That's nearly 15% of total annual mine production simply not there. In any normal market, sustained deficits like this would send prices soaring. But silver didn't respond the way basic supply and demand logic says it should. For decades, it stayed artificially cheap. What? Because silver markets were dominated by paper trading. Massive futures positions, largely controlled by major banks, flooded the market with paper silver that didn't represent physical metal. Prices were capped, suppressed, and disconnected from reality. That system broke in 2025. The physical market finally separated from the paper market. Investors and institutions stopped accepting promises and started demanding real metal. Bars, inventory, delivery. And when physical demand overwhelms paper manipulation, price discovery takes over. Today we're watching that play out in real time. Shanghai Futures Exchange silver inventories are at their lowest levels in a decade. London vault movements hit record volumes, tightening supply elsewhere. Silver-backed ETFs added nearly 200 tons in a single day, the largest inflow since 2022. This isn't speculation. This is a physical squeeze. And with that context, let's talk about why $100 silver isn't a stretch, it's a logical outcome. Reason 1, the gold to silver ratio is broken. Right now, it takes about 73 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages closer to 50 to 1. In ancient monetary systems, it sat near 15 to 1, roughly matching how much silver exists in the Earth's crust relative to gold. At 73 to 1, silver is deeply undervalued. If the ratio simply returns to 50 while gold stays near $4,200, silver reaches about $84. At 40 to 1, it's over $100. And history shows that during precious metal bull markets, the ratio doesn't just normalize. It overshoots. In 2011, it briefly hit 30 to 1. At today's gold price, that would put silver near $140. This isn't guesswork. It's historical pattern recognition. Silver always outperforms gold on the upside because it's smaller, thinner, and far more volatile, with industrial demand layered on top of investment demand. Reason 2, industrial demand is exploding. Silver isn't just a monetary metal. It's infrastructure. Solar energy is the biggest driver. Every solar panel requires silver for its photovoltaic cells, and there's no scalable substitute. Global solar capacity is expected to triple between 2023 and 2030, and every watt of that growth requires silver. The solar industry already consumes over 100 million ounces per year, growing at 15–20% annually. Electric vehicles use roughly twice as much silver as traditional cars due to sensors, electronics, and battery systems. 5G infrastructure requires significantly more silver than 4G. Medical applications are expanding thanks to silver's antimicrobial properties. Electronics continue increasing silver content per device, not reducing it. Industrial demand isn't slowing. It's compounding directly into a supply deficit. Reason 3, investment demand is finally waking up. For years, silver was ignored. Gold got the respect. Crypto got the attention. Stocks absorbed the capital. That changed in 2025. Silver ETFs saw massive inflows, Physical dealers report shortages. Premiums on coins and bars surged because product simply wasn't available. Dealers report wait times for silver eagles and maple leafs not seen since the early 2020s. Some products are outright unavailable. And this is happening at $58. Imagine what happens at $75 or $80 when FOMO kicks in. Here's what most people don't realize. The total above-ground supply of investable silver may be only 2-3 billion ounces, roughly $150 billion in market value. Gold? Over $15 trillion. Silver is about 1% the size of the gold market. Even modest capital rotation causes outsized price moves. The market is simply too small to absorb demand quietly. Reason 4. The dollar is losing influence. The global financial system is slowly, quietly diversifying away from the US dollar. Not in speeches. In actions. Trade agreements are changing. Reserves are shifting. Dollar-denominated assets no longer hold unquestioned dominance. When confidence in fiat currencies weakens, capital moves into hard assets. Central banks are already buying gold at record rates. And even a small allocation shift into silver would be explosive. Global reserves measure in tens of trillions of dollars. If just 1% flows towards silver, that's hundreds of billions chasing a market worth roughly $150 billion. The math doesn't work without higher prices. Reason 5. Mine supply can't respond. Silver supply peaked years ago. Most silver isn't mined as silver. It's a byproduct of copper, lead, and zinc production. That ties silver output to the economics of other metals. Even with higher prices, miners can't flip a switch. And rising costs plus declining ore grades make expansion difficult. The Silver Institute projects mine supply growth of only 1-2% in 2025 and 2026, nowhere near enough to close a double-digit deficit. Even if exploration ramps up, new mines take 7-10 years to come online. Demand is immediate. Supply is slow. That gap pushes prices higher. Reason 6. Inflation and currency debasement. Every major central bank has printed trillions. That money doesn't disappear, it loses purchasing power. Eventually people notice. And when they do, they turn to hard assets. Silver is the accessible hedge. $58 per ounce versus $4,200 for gold. And unlike gold, silver benefits twice in inflationary environments, as a monetary metal and as an industrial input. It hedges currency debasement while riding structural demand growth. That combination makes silver uniquely powerful. Reason 7. The technical breakout is real. From a charting perspective, silver looks textbook. Years of consolidation between $15 and $30 formed a massive base. That base is now support. The breakout above $30 mattered. The move above $50 confirmed it. At $58, silver is in price discovery, no overhead resistance. The inflation-adjusted 1980 high aligns around $150, $200 in today's terms. Measured move analysis from the multi-year range points well above $100. Momentum confirms it. Higher highs. Rising volume. Bullish moving averages. This is what a structural breakout looks like. Reason 8. The short squeeze risk. Despite everything, large short positions remain in silver futures. As price rises, shorts face margin calls. To survive, they must buy, pushing prices even higher and triggering more forced buying. That's how squeezes form. We saw an early version in 2021. The fundamentals weren't ready. Now they are. And unlike meme stocks, silver is physical. At some point, contracts must be settled with real metal, and there isn't enough. You can't print silver to solve that. That's why $100 silver isn't hype. It's repricing. It's catch-up. And it's happening faster than most people realize. So those are the 8 reasons why $100 silver isn't some fantasy headline. It's a realistic target for 2026. But before we get carried away, let's slow down and talk honestly about the risks. Because blind optimism helps no one. The skeptics have a point. Silver has been about to explode for decades, and more often than not, the timing has been wrong. Silver bugs have burned credibility repeating the same forecast too early. That criticism is fair. But here's what's different this time. The fundamentals have never looked like this, not once in modern history. We've never seen 6 straight years of supply deficits. We've never had industrial demand growing at this pace across solar, EVs, and advanced electronics simultaneously. We've never seen ETF inflows at today's scale while physical inventories are being drained. The solar boom isn't a projection anymore, it's happening. The EV transition is real. Supply is genuinely tight. These aren't hopeful predictions. They're present-day facts. Now let's talk about real downside risk. The biggest threat would be a severe deflationary collapse, a deep global depression where industrial activity slows sharply and silver demand takes a hit. That's possible. If factories shut down and consumption freezes, silver prices would feel pressure. But even in that scenario, silver historically holds up better than most assets because it's also monetary. And if history tells us anything, it's that governments never respond to crises with restraint. They print, they stimulate, they debase currency. Which brings us right back to inflation and right back to silver strength. Another concern is technological substitution. Researchers are always hunting for cheaper alternatives. But after decades of effort, silver remains unmatched as a conductor. There's no viable replacement for it in solar panels or high-end electronics at scale. Could that change someday? Possibly. But a shift like that would take years to develop, approve, and deploy, well beyond the timeline of this bull cycle. Then there's the uncomfortable topic of government intervention. In 1933, the US government confiscated gold. Could they do that again and include silver? It's theoretically possible but far less likely. Silver is deeply embedded in industrial supply chains. Confiscating it would cripple manufacturing, and enforcement would be nearly impossible given how widely silver is distributed among private holders. So yes, risks exist, but the risk-reward equation is heavily tilted in favor of the upside. The downside? Maybe silver drops from $58 to $40, roughly a 30% hit. The upside? $100, $150, even $200 if mania takes over. That's risking 30% to potentially gain 75% to 250%. I'll take that trade every time. Now let's talk about how to play this, because knowing what goes up isn't enough, you need to know how to own it. For most people, physical silver is the foundation. Coins and bars you can actually hold. No counterparty risk. If the system freezes, you still own the metal. The most liquid coins are American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics, universally recognized and easy to sell. Larger bars like 10 ounces or 100-ounce bars make sense too because premiums are lower. Buy only from reputable dealers, APMEX, JM Bullion, SD Bullion. Premiums are normal. Expect a few dollars over spot for coins, less for bars. Storage? A home safe works for smaller holdings. For larger positions, private vaults are an option, though I personally prefer direct access. If physical metal isn't your thing, ETFs exist. SLV offers liquidity, but it comes with counterparty risk. You don't own metal, you own shares. PSLV is generally preferred by silver investors because it's fully allocated and redeemable for physical silver if you own enough shares. Mining stocks are the leverage strategy. When silver rises, miners' profits surge because costs stay relatively fixed. A 50% rise in silver prices can mean a 2x or 3x move in earnings. Names like First Majestic, Pan American Silver, Wheaton Precious Metals, and Hecla Mining come up often. There's also the SIL ETF, which bundles multiple miners. But leverage cuts both ways. Miners introduce execution risk, political risk, and management risk. You're betting on companies, not just metal prices. My approach: balance. Use physical silver as your core, your insurance. Add miners for upside. Something like 70% physical, 30% miners, adjusted for your risk tolerance. As for allocation, traditionally, advisors recommend 5% in all precious metals combined. I think that's outdated. In a currency debasement environment with an industrial shortage, 10-20% in silver alone is reasonable. Aggressive, yes, but these aren't normal times. Now let's talk timing. I don't know if $58 is the short-term bottom. Maybe we dip to $52. Maybe we don't. Silver is volatile by nature. What I do know is this: if silver is $100 next year, you won't care whether you bought at $58 or $53. Trying to nail the perfect entry is how people miss moves. They wait for pullbacks that never come or get shaken out by volatility. Instead, buy in stages. Average in. If you're allocating $10,000, don't deploy it all at once. Buy portions over time. Lower stress. Better discipline. As for targets, $100 by late 2026 looks highly realistic. That's a 70% move, completely reasonable given current fundamentals. A full squeeze could take it higher. My plan is to take partial profits at $100 and keep a core position long-term. Because this isn't just a one-year story. The deficit isn't disappearing. Industrial demand isn't slowing. The dollar's problems aren't being fixed. Even if silver tops at $75 or $80, you still win. You protected purchasing power. You own a tangible asset. That beats cash guaranteed to lose value and stocks vulnerable to deep drawdowns. Silver doesn't go to zero. It waits. I've been buying aggressively since the low 30s. Through the 40s. And I'm still buying at $58. This isn't theory. This is real money. Could I be wrong? Of course. But every serious data point points higher. That's why I'm committed. Gold has its place, stability, wealth preservation, central bank preference. But for upside, silver wins. The ratio favors it. The industrial demand favors it. The market size favors it. Bitcoin? Interesting, volatile, speculative. I own some, but it doesn't replace silver. Silver has 5,000 years of history and real-world demand. Crypto doesn't. In a true silver bull market, expect chaos. Big up days. Sharp pullbacks. Emotional whiplash. This volatility wipes out weak hands. You win by understanding the thesis and holding through noise. At some point, media attention explodes. Your neighbor asks about silver. That's when things get hot and when you start trimming, not buying. Here's my rough timeline. Early 2026, consolidation. Mid-2026, breakout past $70. Late 2026, $100 test. Beyond that, depends on psychology. Finally, let me answer this. Why share this at all? Because I believe information should be shared. Because I want to be accountable publicly. If I'm right, credibility matters. If I'm wrong, you deserve to know. Bottom line, silver just hit a record high. It doubled in 2025. The structure is broken. The fundamentals are aligned. The opportunity is here before the crowd sees it. This moment will pass. A year from now, you'll either thank yourself for acting, or wish you had.